Okay, it's been a very sleepy day, I can tell you that. It's a very narrow move on the index at least. On individual stocks, yes, there are some big moves happening now, for example, on Dish TV, NCC, etc. But otherwise, it's just been a very sleepy day. Surbhi, good afternoon.
I think I'm ordering some coffee. Anuj, would you like some to get through the last hour? But yeah, what a market we've had, right? It's about a 45-50 point range. Nothing much is really changing. Today, some of the sector leaders like IT stocks, they've also taken a bit of a backseat. So, I mean, I don't know, maybe we just have to get used to this sleepiness, at least on the index for the next couple of sessions as well.
I think on the index, perhaps we have to. But on the broader market, I think today's been a decent day. It's not been that bad. And I think what the market has done today is, it's sort of rewarded some good earnings. It's sort of rewarded, some companies perhaps on valuations or whatever. Like Canfin Homes, for example, is up about 11.5%. I think for me, the stock of the moment, Surbhi, is NCC. And I tell you what, it's a stock which is corrected a lot. I think CLSA has a coverage on this. I won't be surprised if tomorrow morning you see really big upgrades on this one, because this really is. I mean, I've seen some broader market earnings of the last few days. I think this one really stands out. The net profit is just in line with the estimate because of the higher taxation. Otherwise, I mean, if you look at the other numbers, I think it's a very strong number, and the order flow and the revenue number, I think perhaps they'll have to increase the guidance as well. That, I think, is really your earnings of the day or of the last few days as well.
Yeah.
That one stands out. So that way, there are a lot of stocks which are doing well. EIL, for example, Castrol has recovered, JSW Steel has recovered, but on the Nifty, it's very quiet. Really.
Oh, absolutely. I take your point. At least NCC is giving us something to talk about because it's one solid number. Overall, the mid-cap index slightly better off today. There's some buying. The mid-cap index is actually in the green, while the Nifty continues to be in negative territory. Let's get started. Here is what is lined up. On closing bell today, the market has been absolutely choppy, dragged lower by heavyweights like HDFC and Infosys, along with Reliance, and metal stocks like JSW Steel, Tata Steel and Vedanta supporting the index today. The mid-cap index continues to trade flat with a slight positive bias. Hindalco reacts to its third quarter numbers. The aluminum business has come in largely in line with estimates, but the copper business is a miss. We will be discussing those results, many others and other trends with fundamental experts, SP Tulsian of sptulsian.com, market expert Amrish Baliga and Abhimanyu Sofat of IIFL. Now, with the market continuing to be absolutely range-bound and unable to take out the 11,000 mark, what is the way forward? How should you look at the portfolio strategy? We ask Pramod Gubbi of Marcellus Investment Managers. And, of course, lots of trading ideas coming your way with Ashwini Gujral and Mitesh Thakkar.
Okay, by the way, don't lose sight of Everready. The stock is now, I think it's just broken the 200, and that is where I think that was the really the threshold on the stock, and you've seen a bit of a slide once again on that stock, and that's why that warning in the morning. But anyway, 4.5% lower on the stock. How should you position yourself then in this last hour of trade? We have Ashwini and Mitesh joining us. Good afternoon, Ashwini. It's been a really narrow range. For whatever it's worth, the Nifty is once again taken support at 10,850, now in the green. You reckon there's a trade for last hour? And what about individual stocks?
See, the issue is that 20 points lower, and you start getting the feeling that it's breaking down, and 20 points higher, you can think that it's breaking out. But my sense is that this could be the way markets move for the next 3 or 4 months, where you have elections coming in. Because this time, the momentum is totally out of the market, and maybe you have now a narrower range, 10,700 to about 11,000. So my sense is money making will be extremely difficult in terms of the index, and very narrow moves. I mean, even if you bought at 10,860, you're not really killing it. So 20-30 point moves are very difficult to trade. For the moment, I think it's best to define the range as 10,850 to 10,950. On a good day, you may get 10,950. But I don't think there will be great follow through. Even today, I don't think any sort of large stocks are having any big moves. So just, marking time. Probably selling options, is a better idea, because these options can, vanish with this sort of market. Having said all of that, Tata Global is a buy with a stop of 184, target of 198. NIT Tech is a sell with a stop of 1320, target of 1265. And IGL is a sell with a stop of 267, target of 253.
Yep, IGL, of course, being hit by the news that we earlier were speaking about. Concerns about whether some of these companies will keep getting subsidized domestic gas, or whether they'll have to start importing expensive LNG. That's played out on some of these gas names today. Mitesh Thakkar also with us. Good afternoon, Mitesh. It's a sleepy day. I don't know if you're at all even thinking of trading the index. Otherwise, stocks, of course, as always.
Not yet, Surabhi. And in fact, in the morning also, I suggested that we'll not get much of a movement. Most of the trend indicators have turned flat and sideways. No little bias as yet. So maybe I think 1-2 more days of quiet consolidation might still go on. On the stock side, though, there's some movement. I have a buy on Century. It's kind of rebounding from a very strong support zone of 735. So keep a stop at 733 for bounce backs to 765 zones. And Hindalco had results, but the overall structure is slightly weak. So tempted to take a short with a stop at 205 for targets of 190.
Okay, fair enough. We have SP Tulsian of sptulsian.com joining us, and in a bit Amrish Balika will also join us. Good afternoon. Mr. Tulsian, your thoughts first on NCC. I mean, if you've looked at the numbers, prima facie looking quite good. How do you approach the stock?
Anuj, I think excellent numbers we have seen from the NCC, and probably the trend is likely to be seen continuing. And even in the EPC space, the J. Kumar also has shown, or this about an hour back, even they have posted the good numbers. But NCC seem to be the standout numbers, and in fact, we are quite impressed. And probably it qualifies a buy on the stock after seeing these numbers.
Okay, so NCC is definitely a good set. Look at that, 7% up on that stock. That's a good mover. Mr. Tulsian, good afternoon. So what thoughts on Hindalco, sir? Just came out with numbers. I think it's a mixed performance.
I would call it as a flattish performance, because if you really see, probably they may not have been able to enjoy the benefits which they should have for the copper division. And in fact, coming on if you take the 9 months performance, including Utkal Alumina, probably the performances seem to be flattish for each quarter, maybe with PAT of about 725 crore, with EBITDA of about maybe PBT of about 1,000 crore, 950, 960. So because the aluminium and alumina, the realizations have seemed to be lower, and that is seen reflecting in the aluminium segment for the company, on a sequential basis. So I would call it as a flattish kind of performance, neither cheerful nor disappointment.
Okay. A word on this IGL and MGL, Mr. Tulsian, both down about 4% right now.
See, Anuj, it's difficult to take that call whether the subsidy will be given or not. I don't think that why there should be any kind of changes in this at this stage, and I don't think that government is going to tinker those things. But yes, in fact, if you see, both the shares have having risen quite a lot, and sometimes maybe the market wants some kind of news for the stocks to correct, because even MGL and IGL both have risen. IGL, recently about ahead of numbers, had moved to a level of 300, MGL had moved to a level of 950. But we are keeping extremely positive view, and in fact that's what we have been saying this. But if you take a relative call on valuations, probably the MGL looks to be quite cheap. On a FY20 estimated EPS of closer to about 70, 72. The share is ruling at a P multiple of maybe 13, 14, while IGL is ruling at a P multiple of 21, 22. But IGL has always enjoyed the higher multiple on the valuation front. But still, maybe one can use this correction as an opportunity to buy both the stocks, but our preference will lie more for MGL at the current level.
Okay, by the way, there's some interesting stocks that are moving around. Again, it's an earnings trigger. HEG has got a fresh lease of life after many, many days. Pull up the stock, it's about a 9 to 10% recovery from the lows. Now, numbers, what has happened is that obviously the performance has dropped. Has actually improved year on year. It's the quarter-on-quarter compression in margins, which is not as severe as what the market was fearing. So I don't know, Anuj, now it's triggered this bout of recovery now, whether it lasts or not, considering, where these stocks were, the humongous rally, and whether this is just a one-day affair, I don't know, on these names.
Look, this was last year's rally. This is over now. You'll keep getting these pops. That's okay, Surabhi. you see these moves happen. Sugar, for example, the move played. You have to time your exit in these stocks. That's more important. I think for me, the really curious case today has been of Deccan Cement. Okay. See the chart of the Deccan Cement stock, because what they did was, initially the stock rallied a lot, in fact, up about 11%. The 9-month numbers, were placed in the column in which you put the 3-month numbers, and the comparative was 3 months. So 3 months is also a decent number. It's not bad number. It's perhaps, but that was quite interesting.
So the market continues to dip at the Nifty and the Sensex level. In fact, there is once again a slide that's coming in, taking us back to the lows of the day. Let's just pull out some of the movers and shakers and see where this has come from. Some of the heavyweights, including an HDFC today, have actually been quite weak. So that picture is still intact. And suddenly there's a reversal on metal stocks. Pull out Vedanta, Hindalco, Tata Steel, JSW Steel. From the respective levels, all of these stocks are coming off very, very quickly. The metal space was one of the performing spaces of the day. But anyway, SBI, Axis Bank, these are the, and ICICI Bank, these are the other names where there's pressure coming in today. So sudden slide on the index. Let's get some more trades in then. Sandeep Agle is joining in. Sandeep, it's choppy. The bias is negative. What trades now?
Afternoon, Survi. I would go with a sell in a Havells, stop loss of 717, target 693, and a buy in a Jindal Steel, stop loss of 135, target 150.
Okay, Sandeep, thanks a lot for those trading ideas. Jindal Steel, though, already up about 8% right now, so don't know if that will work, but for now, that stock is up about 8%. SP Tulsian is still with us. Ms. Tulsian, this point I was just discussing, Deccan Cement, of course, it was in light vein, but your thoughts, this 9-month number was pasted in place of the 3-month numbers, and the comparative was shown as 3-month. But have you seen the 3-month numbers? How are they looking?
Senuj, you are right. In fact, the 9 months numbers have been pasted by the company in the 3 months number column, and in fact, this is a big negligence. They should have taken care. But if you go by the maybe 25, 26 rupees EPS, for 9 months, in fact, they have been consistent. First quarter EPS was at about 8 rupees, then second quarter was about 7 rupees. So if you knock this off, they have a EPS of closer to about 9 to 10. One can say that there has been improvement in the performance, but one should not get confused with the EPS of about 24, 25 rupees for Q3, which is in fact for 9 months.
Okay, I just want to point out the market again, because suddenly there's this dip that's come through, and now we are challenged at 10,850. It's rather swift. Let's pull up the banks. ICICI, State Bank of India, they're really leading this charge down. Even Axis is on the lower side. Let's get the intraday of the Nifty as well. So, Anuj, I mean, the day's range seems to be now breaking. I don't know if it's of any alarm or not, but yeah, the weakness quite persistent.
No, I think the weakness is persistent, and look, I mean, the market's made some kind of hard top, so perhaps, and now that we know that 11,000 was a fake breakout, perhaps a move towards 10,600 is logical, Surabhi. And this point that at some point the market will converge, right? The large cap market and the mid cap market, which is either the mid caps pick up or the large caps fall, or both happen perhaps at some point. I think HDFC is really interesting. That's dragging the market right now. That's in fact the low point of the day right now. So let's see. That's been the drag on the market. Look at that, 2% gone on that. Ms. Tulsian, before we thank you, I just wanted your thoughts on this weekly options expiry on Nifty options also, which is now, of course, started. And like we saw yesterday, it's going to be perhaps the #1 product from here on. It's really going to pick up in volumes, just like we saw with the Bank Nifty as well. Should we prepare ourselves for more volatility, especially on Wednesdays and Thursdays?
100% Anuj, because and I think that interest will be more seen in case of Nifty, because the Bank Nifty problem with the Bank Nifty is that lot of volatility is seen. But firstly, that Bank Nifty just have 12 stocks, and that too, Kotak, HDFC Bank, State Bank, ICICI, they in fact create more volatility. But probably people will be, I think that volatility will be less, but participation will be high in case of Nifty. And yes, the things will really catch up, and I won't be surprised to see it having more interest seen, trading interest seen coming in Nifty rather than Bank Nifty.
Okay, let's see how this product really picks up and goes along. Thank you very much, Mr. Tulsian, for being with us and answering all the questions today. Okay, on that note, let's move on to our next guest, Pramod Gubbi. co-founder of Marcellus Investment Managers, is with us on this leg of the show. Pramod, good afternoon. Thanks for joining in. So, the Bulls were hoping that maybe they'll gain some momentum, but every time we come to Mount 11,000, it's like, getting cold feet. Is this market looking like it'll just keep, being in this range, or do you think it's looking unhealthy and maybe we'll see a bigger correction?
So I guess the latter would depend on how some of the global factors play out, and most market participants really haven't got a grip on it, if at all. Whatever they thought was a grip has been loosened even further, particularly given the action of the central banks in the last couple of weeks. Starting with the Fed U-turn, you had the Bank of England and the Reserve Bank of Australia and our own RBI, which has clearly created a sense of uncertainty in terms of where liquidity is heading. What is the real assessment of the global economy? Just when we thought that employment numbers across the world are picking up, the central bankers' commentary has been one of caution. So, if at all, I think there is more volatility, there is more uncertainty in the minds of market participants, and I would think at the bare minimum a range-bound market movement is a given. More so, I guess, given our own local factors, given the uncertainty, political uncertainty, most market participants would like to prefer to sit on the sidelines, and hence, particularly on the upside, hard to see a breakout.
Hard to see a breakout. Pramod, good afternoon. And, that's not even the problem, right? The problem is broader market. Nifty, we are talking about 11,000. Broader market is resembling 9,000. Your thoughts here? Is this just the excesses of 2017 getting cleaned, or is there more to it?
No, I think it is. It is some ways the excesses as well getting adjusted to. We need a little bit of catch-up. It's just that catch-up period has been extended given the big event later in May this year. And it's also the reflection, the difference between the Nifty and the broader market is also a reflection of the market participants' mood, that you'd rather park yourself in more large and liquid names which you can exit at the first instance of trouble, rather than betting on small and mid cap where liquidity is not that easy. So, and that situation is likely to continue. I think if there's an incremental money coming into the market, much of it will go towards the large liquid names, and hence that diversion or rather the gap in performance will sustain at least until the big event.
So, by the way, this, as we were exactly discussing, that the timing is so good for this stake sale, the Sooty stake sale. The non-retail portion has already been subscribed. I mean, one time that issue is done. Let's see how it plays out in terms of oversubscription now. Axis Bank in focus. Pramod, so at the portfolio level right now, what is the mix between large cap, mid cap, small cap for you? And is it a conscious sort of strategy to maybe veer closer to the larger companies than the smaller ones right now, considering the environment?
No, ours is a market cap agnostic strategy. It's just that we try work bottom up. We look for long-term consistency in terms of growth and return on capital employed, as long as 10, 15 years at times. Given the sort of longer track record that we look for, naturally the portfolio tends towards more large and mid cap names as opposed to small caps. So I would say about 70% of the portfolio is large caps and the remaining is mid caps and pretty much nothing in small caps. And this is not a conscious choice, it's just a reflection of the sort of filters and criteria that we apply for stock selection.
Okay, that's interesting. Pramod, the one sector which was in a bear market all through last year, second half, was autos. It looked like it was coming out, but then we have had issues like Tata Motors coming out with that howler, Mahindra and Mahindra scaling down the guidance. How you position on in this space? I know it's a stock specific story, but anything that looks interesting at current levels?
No, I think it is a diverse sector, like you said. You can at best categorize them into three buckets, and each of them have different drivers. Even at this point in time, even after the correction, I think there is some margin of safety emerging. I would say, looking at two-wheelers. And that would be relatively more positive, but I would like valuations to go down a bit more. Remember, there is also competitive threats which are rising across the auto segment. four-wheelers and two-wheelers. Within two-wheelers, the cruiser bike segment is likely to see more competitive pressures given the tariff cuts on some of the imported components. But having said that, I think given the sustainability of demand, I would look for two-wheelers at this stage, perhaps a little more correction in terms of margin of safety. Commercial vehicles are, on the other hand, perhaps more directly linked to any sort of recovery in the industrial cycle. We had a good run in terms of sales growth over the last 2-3 years, but that was more of either an element of catch-up or front-running of some of the regulatory changes that were drivers for the industry, and not really the underlying driver, which is pretty much the industrial cycle picking up. Maybe on the other side of election, if we see a recovery in investment cycle, at that stage you might want to look at commercial vehicles, which is more of a, I would say, a capital good rather than an automobile stock. So I would look at the sector in different lens, and like I said, two-wheelers perhaps is ahead of the other two categories.
Okay. So if you're not looking at a revival in the capex cycle anytime soon, then what are the key overweights right now? I'm thinking you're probably going for safety then. I mean, are you looking at IT, maybe some of the larger banks?
No, like I said, our portfolio is largely bottom up. But if I were to look at sectoral movement, I would look at private sector banks. I think given the sort of events initially with the PSU banks, we haven't really seen any major recapitalization for them to participate in the growth. And the space occupied by the NBFCs and the bond markets will clearly get vacated, and that's where the private sector banks can take significant market share. And private sector banks are armed with fairly decent CASA franchises, particularly the ones that have access to CASA franchises and hence the low-cost funding. It's a great time to be and take market share from the rest of the financial sector. So that's one sector. I think IT and pharma are also in a decent position. I would wait for further clarity on the Fed, because much of the data points suggest that we're still in a decent environment as far as the global economy is concerned, barring the implications of the trade war. And in that case, I don't think the U-turn that the Fed took in its policy announcement is likely to sustain. We're already beginning to see the dollar get back to its 2019 highs. And hence any further dollar strengthening would support some of the exporting sectors like IT and pharma.
Okay, the market's slipping more now, by the way. The bank nifty is now down about 200 points. So ICICI Bank is acting as a bit of a drag. Same is the case with SBI, and both these stocks have now sliced through that support level. 350 on ICICI Bank and 280 on SBI, and that's gone now. So a lot of these stocks seeing declines right now. Pramod, on budget day, your colleague Saurabh Mukherjee made a very interesting point that stuck with me about these recent accidents in the broader market with some promoter issues. Largely, it's basically stemming out of the liquidity crisis right now, like most of these cases do. You reckon there's some more to go in Indian market because of the liquidity crisis?
Yeah, I reckon so, because this is a phenomenon we've seen across time periods, across markets. It's a direct reflection of the tightening of liquidity, and it is happening in other markets as we speak, and I wouldn't be surprised if more such events continue in India as well. And partly I think some of the effects of the liquidity surplus that we saw post demonetization, which put pressure on yields, forced some of the lenders to take additional risks without commensurate returns, and hence that's created a set of assets which have sort of deviated from their fundamental strengths, ability to service the debt, and once the liquidity is gone, you've seen global liquidity and local liquidity tighten over the last few months, and these are times when these things unravel, and I wouldn't be surprised if there are more to come.
Okay. So finally, Pramod, then what is the sense and what is the call? What should one do, considering there's no clarity on the index? As you're saying, perhaps better to stick with the larger stocks. Then in terms of top themes, what would you look at?
Like I said, I think best to stay bottom up. There are thankfully companies in India which deliver irrespective of the macro. In fact, they tend to perform better when the chips are down, either because there is a flight to safety of the rest of the market, and these companies tend to hold on to their stock prices or multiples. And if the economy is going through stress, these are the sort of companies we tend to take market share, and even their earnings are cushioned to some extent. So a bottom-up strategy where you have visibility of strong economic moats, competitive advantages, which can underpin sustainable earnings growth, is perhaps the most sustainable investment philosophy you can cover, because then you don't have to worry about any sort of external events, be it general elections or RBI policies or trade wars across countries. Having said that, it's easier said than done, and hence if you were to look at some thematics, like I said, I think private sector banks would be the best theme to play, given the sort of difficulties we are seeing for NBFCs, the bond markets and PSUs. Effectively, private sector banks with strong CASAs have a field day. If at all the economy has to grow, you'd have to grow the credit in the system by at least 12-13%, and that's a reasonable tailwind for the private sector banks.
Pramod, we leave it there today. Thanks a lot for joining us. Good talking to you. That's the review from Marcellus.